The song goes, breaking up is hard to do, but in business, sometimes it's the right thing to do, especially for shareholders. Just take a look at General Electric. Back in November, the industrial conglomerate announced plans to split into 3 companies, with one focusing on aviation, one on healthcare, and one on energy. The split represents one type of catalyst Barron stock pickers look for when they see stocks poised to rise. But the announcement of GE's split was also a bit of an emotional one. For much of GE's 130-year history, a split would have been unthinkable. In recent years, it became unavoidable. GE dates back to 1892 and was founded by Thomas Edison. It was one of the first companies in the Dow Jones Industrial Average in 1896, and it grew to become one of the most storied businesses in the world. Its operations included industrials, healthcare, and finance, and it even owned the NBC television network. But GE struggled since the financial crisis of 2008 and 2009. Being big wasn't necessarily better, and GE bought and sold businesses in the hopes of having the right mix. In 2018, the company made the drastic move to slash its dividend. By late 2021, it had long been clear that GE wasn't the company it once was, and a split made sense. But even though Wall Street initially celebrated the news, shares fell in the 2 months since the announcement. My colleague Al Root says investors are missing the good news.
We're 3 years into a completely new management regime. Larry Culp was brought in, first outside CEO in the company's history, paid down debt, sold assets, tried to repair the balance sheet, put the business on solid footing. And so really now, you're sort of evaluating General Electric like you would almost any other industrial conglomerate. GE is a huge supplier to the commercial aerospace industry. As COVID fears fade, as aerospace recovers, as aerospace businesses regain some momentum lost over the last couple of years, General Electric stands to benefit. And then it's breaking up into 3 companies. It's the epic split. The ultimate American conglomerate is de-conglomeratizing. And what they'll be left with is a healthcare business, a commercial aerospace business, and a power generation business. And I think when investors take a look at all 3 companies on a standalone basis, you'll get into that valuation multiple arbitrage, and I think that can generate value. So COVID improvement and epic breakup are the 2 reasons to be excited about GE stock.
Once the spin-offs are complete, investors can expect to be rewarded by owning shares of 3 attractive companies. Put another way, the sum of GE's parts is greater than the value of the company as a single entity.
GE Healthcare, we know what they do. They make CT machines, they make x-rays, they make ultrasounds. It's a business not unlike Siemens Healthineers. Philips also makes these sorts of things. So you look at those 2 companies, you see where they trade. That is where General Electric Healthcare will trade. The aerospace division, it's widely viewed as the most valuable, the crown jewel of the General Electric business portfolio. The controversial one will be GE Power. They have a coal business, a natural gas business, a nuclear business, along with like a wind and renewable power business. And analysts will debate what's it worth. Is the natural gas power generation business going to grow? What's the cash flow going to be like at these dying businesses? How fast will renewable power grow? What's their franchise like? I like to say, GE Power valued at 1x sales. If you can start with that as a reasonable valuation, then you can see how the business actually performs when it's on a standalone basis.
Sticking with GE during the turnaround may bring your portfolio to life.